Hi, it's Noel Fielding with Santa Cruz Moves Team Fielding. I'm taking a little drive down West Cliff over to Natural Bridges State Park, where I'm going to go for a swim this morning. And I was thinking this morning what I could do to help new buyers, first-time home buyers, or even experienced home buyers, prepare a little bit for shopping for their first home or for their next home. And so I have a little presentation I want to show to you. It shouldn't take more than a few minutes to give you a heads up on how to plan for what you might be able to shop for and what's going to work for your budget. Okay, home buyers, this is a nice little tool. It takes a little bit of math and a little bit of work, but it's not incredibly complicated. It can be. Depending on your circumstances, things can be very, very challenging for someone to learn how to estimate their home buying ability. The first materials you'll want to get to start this process is your W-2s and your most recent pay stub. When you look at those, you're looking for a couple main ingredients there. First, what you're going to look for is your total gross income on your W-2 and your pay stub. Ideally, most lenders are going to look at 2 years of your income. So if you have the last 2 W-2s and your pay is consistent with what you've been making over the last couple of years, then it should be pretty easy to calculate or estimate anyway. And remember, this is not a pre-qualifier. I'm not a banker, a lender. Although I've worked many years in this industry, there's going to be no ultimate substitute for getting you pre-qualified than talking to your bank, local bank or mortgage broker. So if you take the gross income from your W-2s, okay, from the last 2 years' W-2s, and I'm using an example here of a 2012 W-2 of $125,000, and then I looked at a pay stub, and it happened to be dated December 15th, which is about the time that I'm doing this, of 2013. You're going to see that there's a little bit made more this year in less time, $127,650 year to date. All that means is this person probably saw a slight increase in overall wage. So we add the two figures together, the $125,000 and the $127,650, and we come up with $252,650. And you divide that by the total number of months. Assuming that the W-2 for this person covered the entire 12 months, meaning that they didn't start that job in June or something like that. So this is going to be from January 1st of 2012 to the last day, December 31st of 2012, they made that 125. And again, starting January 1st of 2013 to December 15th, 2013, they made it 127,650. So you come up with 23 and a half months, or 23.5 months. Divide them total income for that period by the number of months, and you come up with an average of $10,751.06 a month. Now, lenders only allow you to use a portion of that income. And again, if you're a husband and wife, you're going to need to do the same thing for your spouse if you're planning on buying the home together. So that would obviously be a significant addition to this person's monthly income. But again, the lenders only let you use a portion of it because it's all based on risk for them. They want to make sure that the portion that they allow you to use for your housing and for your overall debt is a very safe number, and that you're in no danger of being overly indebted and not able to pay your bills. A high debt ratio would be somewhere around 40%. Back in the day, they even went higher than that. Some banks are much more conservative than that. So there's no easy answer for that. You need to, this is an estimating tool, okay? When you actually go and get qualified, they may use a different figure than that. This is an estimating tool that's going to give you an idea of what kind of house value you can shop for. So we're going to use this 40%. So we calculate 40% of the $10,751 and 6 cents a month times 40%, or on your calculator, 0.4, and we come up with a figure of $4,300.24. This is the total amount that a 40% debt ratio will allow you to have for all debts for the house, and including any qualifying debts. So now, for us to figure out what that number is for just the house, we need to remove the qualifying debts. So you want to calculate your qualifying debts. This person is going to use, they have a department store credit card that they have a balance on, and their payment is $25 a month. The car payment is $425 a month. He owns a boat. He's got $155 a month, and he's got a big Visa that he has $122 a month on. So his total monthly, that's $727. Again, if there's two people, you'll need to think about all the debts that each of you have. Now, if you have joint credit cards, you only need to ding yourself for the payment for one of you. So the Visa payment that you're both named on, you don't have $222 payments. And again, you're just using the monthly obligation, not the total balance. So we're going to take our $4,300.24 of total usable income, subtract out the $727 in qualifying debt, and that leaves this person $3,573.42 for housing allowance. Now you want to go grab yourself a mortgage calculator. We have a free mortgage calculator for you to use on www.santacruzmoves.com. And there's lots of them on the internet, so you can certainly go in there. And you can play with your numbers a little bit based on today's interest rates, okay, being around 4.3% on a 30-year loan. This person should be able to afford somewhere around $550,000 loan. There are some other factors and pitfalls that you need to watch out for in calculating this figure. You may have PMI or mortgage insurance if you have less than a 20% down payment. So if you're looking at a 5% down or something like that, more than likely you're going to have a mortgage insurance premium that you're going to have an additional expense. So that money those monies are going to count against that overall house payment. Also, any homeowners association dues, those are an expense that you're going to have to account for, or condos have association dues. You also need to calculate and expect for your property taxes and insurance, your hazard insurance, because those, although there aren't debts that are showing on your credit report, there are debts that you're going to have to pay each and every month, and they know you're going to have that obligation. So if you don't calculate and account for these things, you can have it backfire. You can really be thinking that you're affording $3,000 a month, and you're really more at about $2,500 a month after you add those additional debts in there. So think about that. Often larger down payments will attribute you to getting lower interest rates, and as well they might give the lender the ability to give you a higher debt ratio. So they're typically using a 33 or a 35% debt to income ratio. They might let you go to that 40% or 45% or something higher than that. I don't know. I don't know all the lenders out there. I don't know all their policies. I just know from my past experience that that is how they evaluate risk. And the lower the risk is in one category, because you've put a large down payment on the house, the more they will be willing to consider a higher risk in another category. Another thing you want to make sure, a lot of people, when they're just thinking about getting in and purchasing a home for the first time, they go out and they pay off all their debts, or they close out all their credit cards. These are not good things for you to do. Having zero debt is not really great. Having a low debt is good. But a zero debt or no trade lines, even though your credit score is high, it shows to the underwriter, the person who is evaluating your credit worthiness with that lending institution, it's going to tell them that you have either a fear of financial responsibility or don't have the ability to be financially responsible. These are all things that they'll concern them when making the decision to lend you that money. Other potential problems, making big changes in your job. Let's say you went from being a grocery store clerk and now you're going to selling insurance. That change, a complete change in the industry that you've been in for some time, is going to be a turnoff. So they really want to see that you are consistently employed for 2 years. So if you have made a change or you're considering making a change, if you're staying within the same industry, you're going to be easier risk to evaluate. So I was a grocery store clerk at Jack's grocery stores, and then I got a job at Rayleigh's or Bel Air in June, and I took it. And I took it because they offered to pay me more money. I'm staying within my same line of work. I'm staying within my same profession, and the only thing I did was made a change for my betterment. So those kind of changes make sense to underwriters, but ideally they will consider job changes or changes of profession against you, and it could be a problem because you won't have 2 consistent years of income in the same profession. Just the opposite of not having enough debt, having too much debt. It's going to scare them off. They can look at that and look at the potential of all the debt that you had. You may have 10 credit cards out there, but if all those credit cards could amount to $1 million in debt, they may not really favor that, and it could be a risk concern for them. And once you get qualified or pre-qualified for a home loan, don't do anything crazy until you've moved in, until you've got the keys in your hand and you've closed the deal and you've moved in your house. Don't change anything. Don't switch jobs in the middle of it, and do not go out and open a bunch of credit cards or buy a new car and go buy an expensive new car, because that will show up before the closing, and they can go back and look at that, and they can cancel your loan and dequalify you from that loan that they were going to give you. There's no promise, okay, on a loan, on a mortgage, until you've both signed the dotted line and the rescission period is cleared. So don't make any changes. Other things that you want to keep in mind: alimony and child support either being paid in or going out as an expense. These are things that can be counted against you or for you as additional income. So consider the additional, when you're thinking and calculating your income, consider all the sources of income that you have. But keep in mind, the banks are like the judge and jury. The underwriters, it's all about what you can prove to them. So if your child support that you're supposed to be getting, this $500 a month or $1,000 a month, whatever that number might be, if it's not being paid to you consistently, and it's not verifiable and it's not provable, even though you have a court document saying that this is supposed to be getting paid, they're not going to give you credit for it. Same thing if you got divorced or something like that, and your ex-spouse is supposed to be paying off credit cards. As long as your name is on those credit cards, as long as they show on your credit report, they are not going to remove those debts from your risk. So these are some additional things that you should know and consider. Don't let the lending process be emotional to you. I've seen hundreds and hundreds of clients over the years get very frustrated by the way that the bank looks at it, and it's not an emotional thing for them, and it shouldn't be for you. It either is or it isn't. But make sure that your qualifying is something that's going to stick. If you have any red flags, any of these things that I've mentioned to you, make sure you disclose all that to your lending officer, your mortgage broker, or the bank officer that you're working with, and let them know, because the last thing you want it to do is think that you're closing a deal on a home and then having your loan fall through at the last minute. And right here, we want to make sure that you understand, again, this is not a qualifier for you. This is not a loan qualifier. This is not a commitment to lend. I'm not a financial institution, and just because these numbers work out for you doesn't mean that you're going to ultimately get the loan that you think you're going to get. What it's meant to do is give you a tool, an ability to calculate how much money is available to you based on a pretty standard bank evaluation and what you might be able to qualify for. Then when you go and you call a realtor to get to see a house, you're going to know that the house you're looking for, and hey, I saw this house on 222 Jones Street, that when you guys go there, that you have a good idea that that thing is a possibility. And if it's not a possibility, well, you'll know it, and you'll be able to shop on the internet or tell your realtor, your buyer's agent, just what it is that you can afford, and he or she may want to go out and take that to the next level and get you pre-qualified, which is always a great thing to do. Hope you find this information helpful.
Well, for now, I hope that was informative and will help you plan your next purchase a little bit easier. Of course, the best bet, once you get an idea of what it is that you're shopping for and what your price range is about, go out and get yourself pre-qualified. If you need help with that, or getting this purchase done, and you find a house that you think you're interested in, don't forget to contact me at Noel@AndersonChristie.com or Team Fielding at AndersonChristie.com, and you can call us at 831-428-3575. Thanks, and we'll see you next time.